Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, March 5, 2018. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And we had a pretty stout update today. The SPDR was up about $2.80, about 1%. The S&P 500 up 29 points. The Dow was leading up 336 points, or almost 1.4%. The Nasdaq was up 1%. So everything was up across the board, with a minor exception, which we'll get to in a few minutes. But nobody should be surprised at the update today. Let's just recap for a couple of seconds what happened last week. The market went down for 3 days in a row. It went down right into a 50% retracement level from pivot low to pivot high. This marked a 50% retracement level. It also coincided with the 100 period moving average, and it also coincided with a former consolidation area. That was enough to tell you that the market, at least for a short period of time, whether it be intraday or for a few days, would find support and would bounce off that area, which it absolutely did. And certainly, traders that have taken the E-mini Trader course understand the importance of the confluence of things that I just discussed and why the market was likely to find support in that area. And I will tell you that from some of the emails that I got on Friday and over the weekend, traders were watching for that area and traders did go long in that area. So good for them. Then we discussed the market activity on Friday. We started lower. The market reversed. We finished well. We did get stopped by the 20-period moving average, the red sloping trend line on Friday. However, we did have a positive close, and we were expecting follow through today. We obviously got the follow through today. We almost reached the 50-period moving average, which is the blue sloping trend line. We didn't quite get there. The market backed off just a tad at the end of the day. However, there most likely is some more upside coming tomorrow. So I have a number on the chart at 273.55. That's the minimum target that I would expect to be reached tomorrow, meaning Tuesday, in Tuesday's trading activity. Now, could we go slightly higher than that? Sure, we could. We can go up to 274, maybe even a touch higher. Do we get much higher than that tomorrow? I would think not. I think 273.5 to 274 and maybe 274 and a quarter would be all we'll get to on the upside tomorrow. And then I would be looking for the market to somewhat stall out. But what's going on here, and this is another thing that's obviously taught in my course, which is we have another zigzag or ABC pattern developing, right? So we have the A leg is the leg up from the bottom. The B leg is the leg down that completed late last week. And now we're in the midst of a C leg. And the question is, does the C leg continue and actually complete? And the official completion would have to be above the high of the A leg. Now, that's not going to be a small task. That's a tall order to get all the way up to 278.80 or above. Is it possible? It's possible. Is it probable? I don't know if it's in the probable camp. Frankly, it's just too early to tell whether or not we're going to get up there. The way we know we're going to get up there, and one of the things that would happen is we would get above this red candle high. If we get above this red candle high, then you can bet your bottom dollar that they're going to at least test the 278.80 level and most likely pierce through it. But that's close by, is not a lot of meat left on the bone from up in that zone. And then there's another very, very good area up here that would be resistance. You have a gap fill right above that. So anywhere up in this area, the market would most likely not be able to get through without one heck of a fight. So I'm not looking for the market to make new highs anytime soon. Is it possible? That's possible. Is that probable? No, that's not probable. There is a chance that the market gets pulled up into an important date that comes around the third week in March. So if we see the market continue higher, that'll give the opportunity to get all the bulls sucked into the market. Everybody will think that the market is fine. We're going to make new highs. so on and so forth. And if we get sucked up for the next couple of weeks in this market, there is likely a turn coming around the third week in March. We'll play it by ear. We'll see what happens. If we're trading down into that time frame, it may be a turn for a move higher. If we're trading up into that time frame, it may be ripe for a turn lower. Too early to tell. I don't necessarily know which way the market would turn if we're going to turn at that point in time and in the third week in March. But what's important is it's generally a pivotal point or turning point for the market. So we'll have to see whether the market's trading up or down into that time frame around the third week in March. Another little point of interest, which is tomorrow, which is the 6th of March, is the anniversary of the absolute low that was found on March 6th, 2009. So it was 9 years ago, really at the conclusion or the bottom of the credit crisis from that really began in 2007 through 2008 into March 2009. The absolute low on the S&P 500 was, ready for this, 666, and that was found on March 6th, 2009. So tomorrow is the anniversary date. I'm not sure it's going to have any meaning in this market whatsoever. It's possible, but I'm just bringing it up as a point of interest. Looking over at the IWM today, the IWM traded up into its 50-period moving average, backed off a little bit. You can see that we're peaking back above the upsloping trend line from the long-term chart. That'll be once again important at the close of business for the month of March. February closed comfortably below that line, and now we're challenging that line one more time. So we'll see whether or not we have a bona fide failed breakout or we recapture that line and close back above that line at the end of March. A lot of time left on the clock, so it's way too early to tell. But you see much of the same pattern developing here in the IWM as we just talked about on the spider chart. Here's an A leg of a ABC, so here's the B leg down, and then here's the C leg, and it will be officially complete if we can get above the high of the A leg. Now, complete is complete if we get a high above the high of the A leg. Doesn't mean we can't go to new highs, and it doesn't mean we won't stop here and turn back around. You really just don't know at this point in time. We'd have to use other technical indications at the time, but right now it looks very similar to the spider chart, and it looks like an ABC pattern. Talk for a minute tonight about the VIX chart, because I want to point something out that if we get to a certain area, we will want to be looking long on the VIX chart, and here's what it is. So let's assume for a second that we do get further rally in the stock market and we challenge some higher numbers for the next couple of weeks. Let's just assume that one of the scenarios is in the stock market that we play out up through the next couple of weeks on the upside, culminating in a high around the third week in March. Now, if that's the case, we're going to see the VIX down in these areas here, down towards the 100-day and 200-day moving average, maybe slightly below that. I'm not sure we get much below that, but we could. So if we get down to about this area in here, let's say 11 to 11 and a half, in that neighborhood in the VIX, even if it's lower, in the 10s for sure, that will be an opportunity to once again go long the VIX. And you know what I always say, markets like to come back and test former breakout and former breakdown areas. If the VIX should test this area down here, right in here is a former breakout area. Okay, so the VIX consolidated in this zone. We went up a little bit. It's hard to see because it was a slight move compared to the move we had following that. We consolidated in a bullish fashion, and the VIX popped up to the upside. We backtested a little bit, a little pullback, and then we took off to the upside. Now, if the market decides to come back and retest or check in at that former breakout area, that would be an opportunity to buy the VIX long. How do you do that? My preference is to buy call options on the VIX because you know your risk is well defined. I'm not particularly in love with some of the VIX exchange traded products, the leveraged products. We saw one of those fail the last time the VIX had a big move up, and I'm just not willing to risk my capital in one of those products knowing that it can fail. Those products are constructed in a way that most people just can't understand, A, the risk associated with them, how they're put together, what they actually buy in order to track the VIX, and all that stuff. It's a derivative of a derivative, I think even of a derivative. So it's a little squirrely in my opinion, and if anybody were to go and read any of the prospectuses on those exchange-traded notes, now there's a difference between an exchange-traded fund and an exchange-traded note. An exchange-traded fund is a mutual fund that's traded on the open market that does track a basket of stocks, for an example. However, when you have an exchange-traded product that tracks the VIX, for example, it's called an exchange-traded note, and the only thing that backs those notes are the full faith and credit of the issuer themselves, and they may or may not be solvent at some point in time. So it's not something I'm willing to do. I'm certainly not willing to hold those things overnight. I may trade them intraday. That's okay. But holding overnight is not for me. So my preference is if I am playing the VIX, I prefer to play call options on the VIX, but I'm only looking to play call options on the VIX if we get down toward that former breakout area that we just discussed. Right in that 11, 11 and a half, anything in the 10s would be a home run, I think. So from that standpoint, I will be looking if the VIX starts to get down to that area. Is it going to get there? I'm not sure. You're going to have to get a pretty good rally in the market for the VIX to get down to that area. But I just wanted to point out a possible trade to look at for the future if we should get down there. And those of you that have been watching me for a while know that each and every time the VIX would get down in the low 10s or even in the 9s, I would pound the table literally that you have to buy either call options on the VIX or find a way to play the VIX long, because it's not going to stay down there for very long. It never does. And I can't tell you how many times that turned out to be correct. You can just see it down here as we bantered back and forth. We would make a low and we would pop up. We would make a low and we would pop up a little bit. We would make a low and we would pop up. And we would make a low and we would pop up. And then we took off. So each and every time the VIX gets down to those oversold territories, and I use the term oversold sparingly, because as we know, markets can stay overbought and oversold for a lot longer than we can remain solvent. And that's why, sometimes, and that's why if you are playing call options on anything, especially the VIX, you have to give yourself some time. If it happened at the end of March, I wouldn't necessarily be comfortable buying call options expiring in April. You have to give yourself at least 2 or 3 months to let it play out to the upside. All right, flipping over to the transports. Now, the transports were up today, but they weren't up all that much. In fact, they were down earlier. Transports finished up 15 points. They're struggling here a little bit, certainly not pacing the IWM, which is my favorite market leading indicator, certainly not pacing the SPDR, the Dow, the NASDAQ. So it's possible that the transports are trying to tell us something. It's possible that they're giving us a clue that this market may not have much more upside in it. We'll see what happens tomorrow. I'm watching it very closely. I'm just not sold when I look at the transports that this market is just going to take off to the upside. You really need participation from all the major indexes, and you certainly need participation from the two, or at least my two favorite market leading indicators, which are the transports and the IWM. And if you're not getting participation in the transports to the upside, it's unlikely this market has much farther to go on the upside without another turn back downwards. We'll also take a look at the broker-dealer index tonight, and the reason is because the move it had was over 2%. And when the broker-dealers are up, and it's not just the broker-dealers, but also the financials. We can look at the XLF, for example, and when you take a look at the XLF, you'll see that the XLF was also up nicely today. Looks very similar to the SPDR chart, looks very similar to the IWM chart and all the others. But when we go back to the broker-dealers, you'll notice that it was up $6 or over 2% today, and we're approaching the highs that were reached just a few days ago. We put in a tail candle. We talked about the tail candle at the time, that this is normally the signal of at least a short-term trend change. We had the short-term trend change down. We traded right into the 50-period moving average, and here we are back up. The reason why I want to bring this up is because without participation from the broker-dealer index, the financials, the market is unlikely to have a significant move higher or significant move lower. So, for example, if we're seeing the broker-dealer index move higher, it's unlikely that we're likely to see a breakdown in the overall stock market, and the flip side is the case as well, so vice versa. So as long as the financials are strong, that's generally an indication that the market has a bid underneath it and likely has some more upside as long as the financials remain strong. The gold market. So if you remember from last week, we came into the 100-period moving average in the gold market down around 1305. The low was 1303.60. We had a nice reversal off that the following day. We're into the convergence of the 20 and the 50-period moving average. That's where price was rejected today in the gold market. So I think this is still relatively weak. And until and unless, and there's no trade in here right now because, again, there's no pattern that's telling us definitively that there's a high probability that there's an upside or downside in the gold market. Until and unless we can close above this level right here on a daily chart, that will be bullish if we can get above that on a closing basis. And if we can't and we begin trading down to this area and below, that's going to be a negative for the gold market and spell lower prices ahead. And even if we came back down to this area where we've already tested around the 100-period moving average, you have the 200 below that. This black line is the 200-period moving average. The fact that we came relatively close to that and bounced off that level, if we came down again with any kind of velocity, that 200-period moving average wouldn't have as much meaning as it once would have had. For example, if we came down to that level the other day when we made an attempt and got stopped at the 100-period moving average. So what happens is the fact that we were already close to here, bounced up higher, if we came back down, it diminishes the importance now of the 200-period moving average. So if we made a new low below the low from the 1st of March, then I think much lower prices are coming in the gold market. And on the flip side, once again, if we get a high above, or if we get above, pardon me, the high of 1338.40 on a daily chart and close above there, that's going to be positive and bullish for the gold market. Other than that, we're in the middle of a range, and in the middle of a range, there's too much uncertainty one way or the other. So when you don't know exactly what to do, you do nothing. Looking at crude oil, we had a nice up day in crude oil, up over 2% today. And we've been talking about the fact that as long as crude can maintain these levels, and now we're above the 50 and the 20-period moving average, that's a positive. The question is this an ABC pattern? Do we have an A leg? Did we have a B leg down? And now are we beginning the C leg? And will this complete above the high of the A leg? And will it keep going? And will it keep going up to my ultimate target on the upside, if we can get there, of over $73 a barrel? The hurdle that we're going to have to get above is $65.23 a barrel. We're going to have to get above that level on a weekly chart closing basis, meaning by a Friday close. If that happens at the close of business on any week, then I think the move is on to the upside up to $73.78. That's my number. It could come up slightly short of that, and it can go through that. It could spike it by a little bit up to 74 and change. But that's an approximation of a number that I came up with, $73.78 a barrel. The hurdle that we really need to get above is $65.23, and that has to be at minimum of a Friday close, a weekly close. And with that, folks, it's everything I wanted to and intended to discuss tonight, so we'll give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.